Hey there, fellow traders. Welcome to another episode of Crypto Corner, the video podcast where we talk everything crypto related to help you navigate safely in the blockchain space. I'm your host OJ. I'm a crypto analyst and investor since 2016, and today we're diving into the world of trading with the 10 biggest mistakes that can drain your trading account faster than you can say bull market. But fear not, my friends, because I'm going to equip you with the knowledge to steer clear of these pitfalls and boost your chances of success. So sit back and let's get started. Trading can be a very profitable endeavor, but it's also a very risky one. If you're not careful, you can easily make mistakes that will cost you a lot of money. So today we will discuss the 10 biggest trading mistakes and how to avoid them, starting with number 10, not having a trading plan. This is a roadmap that will help you stay on track and make informed decisions. It should include your goals, your risk tolerance, and your trading strategy. Why do you need a trading plan? Well, because it can help you make logical trading decisions and define the parameters of your ideal trade. A good trading plan will help you to avoid making emotional decisions in the heat of the moment. This means easier trading. All of the planning has been done upfront, so you can trade according to your preset parameters. Also, more objective decisions. You already know when you should take profit and cut losses, which means you can take emotions out of your decision-making process. Also, better trading discipline. I will talk about discipline in a moment, so these are connected. Without a trading plan, you are more likely to make impulsive decisions that will lead to losses. I dedicated a previous episode specifically to this topic, so if you're not sure how to go about it or what is a trading plan, then watch that episode. It will pop up at the end of this video, and you will also find the link in the description below. Before you dive into any trade, make research your first priority. This includes understanding the project, the industry, and the market. Get to know the ins and outs of the project that you're investing in. Some crypto projects have a long history, so research their market performance over the years. That will help you to get a better picture of where the price is going or what its potential. Other projects are too recent, so they will not have enough such data. So don't go too heavy on one crypto if there isn't enough track records to analyze. That's the rule of thumb, but there are exceptions, of course. Some tokens are launched with a lot of hype and they do well in the beginning, so you can jump into this early on, but be ready to sell at the first sight of a bearish trend. You should also be aware of other risks involved in trading that token, so examine its fundamentals very carefully. If you don't do your research, you're more likely to make bad decisions that will cost you dearly. A stop-loss order is an order to sell at a specified price. If you buy a token and the price falls heavy soon after, you can exit your position automatically with this type of order, so you save yourself from an even bigger drop. Seriously, folks, don't skip this step. This can help you limit your losses if the market moves against you. It's important to use stop-loss orders regardless of whether you're bullish or bearish. My preference personally goes for the trailing stop-loss order because it can move up with the price and only gets activated if the price drops by a specified percentage value. For instance, if the price drops by more than 10%, let's say, I anticipate the trend to reverse, so I exit before the market goes down by another 10 or 15 or 20%. To understand more about trailing stop-loss orders, check out this video. It will also pop up at the end of this one, and I will drop the link in the description below, so grab it from there. Also, don't forget to take profits when you're in the green. Avoid the temptation to hold on to your gains for too long. Instead, be disciplined and take profits when the time is right. By doing so, you will safeguard your hard-earned gains and you will prevent potential setbacks. Markets move up and down all the time, so if you see that the market continues to rally, you can jump back in, but don't be afraid to sell whenever you're in profit. That's a mistake too many people make, especially those who are not yet experienced. There's a switch between an investor mindset and that of a trader. Use any peaks for selling, and if you want to trade the same token again, reaccumulate it at the pullbacks. Don't be scared or greedy, as it can cloud your vision and you might miss the chance to lock in profits and become a backholder. If the market turns bearish, it can wipe out all of your profits and you might even sell at a loss later on. Missing the right time to sell can be a trader's worst enemy. Even if you sell at a small profit, that's still better than selling at a loss. Technical analysis, of course, will help you make these choices, but don't be complacent once you enter a trade. Overtrading is another mistake that many people make. Of course, trading can be addictive. It's very tempting to trade every opportunity, but this is a recipe for disaster. So slow down, my friends, and focus on quality over quantity. Be selective and trade only when the odds are in your favor. Resist the urge to jump into every opportunity that comes your way. Don't be a gambler. Overtrading will lead to losses, so it's important to be disciplined and only trade when you have a high probability of success. Sometimes, in fact, many times, no trade is the best trade. Taking unnecessary risks or badly calculated risks is not the right approach. If the market is too choppy and doesn't give you a clear direction, then it's in a no-trade zone, as I call it. So sitting on the sidelines and waiting for the right moment will be a better strategy. Speaking of risks, here is the golden rule of trading. Proper risk management is your lifeline. Determine the maximum amount that you can afford to lose on each trade and don't exceed that limit. Implement strategies to control losses in case of market going against you. Ignoring risk management is like swimming with sharks without a cage. It rarely ends well. Protect your capital and trade with prudence. Well, Rome wasn't built in a day, and neither will your trading empire. Patience is a virtue in this game, so don't expect to get rich quick, and understand that it takes time and patience to become a successful trader. If you're not patient, you're more likely to make impulsive decisions that will cost you a lot of money, as I already said. Being impulsive is the worst enemy of a trader, so take a deep breath and remember that success comes to those who wait. Learn to be patient and not jump into trades unless you have enough conviction that the most likely scenario is in your favor. Which brings me to the next point. Trading requires discipline. Stick to your trading plan and don't let emotions cloud your judgment. Discipline ensures that you make consistent decisions based on logic and strategy rather than on gut feelings or impulses. If you're not disciplined, you're more likely to make mistakes. And let's face it, losses are an inevitable part of trading. Don't let them discourage you. Instead, be prepared for the occasional setbacks and stay focused on the bigger picture. Treat losses as learning opportunities, analyze what went wrong, and adapt your strategies accordingly. Resilience in the face of losses is a hallmark of a successful trader. Losing is indeed part of the trading game. You've got to be able to close a position and take a loss every now and then. It's better to take a 5 to 10% loss to avoid a 20 or 30% loss further down the line. When markets turn bearish, 30% can be the least damage. Some tokens will lose 70, 80% and even 90% of their value during a bear cycle. And if you're holding huge bags, you will feel the burn. Being able to exit at a small loss is much better than waiting for months or even years and being 90% underwater. This is why I exit all of my altcoin positions at the start of each bear cycle. It's my own rule and one that I learned the hard way, which brings me to my last rule here: not learning from your mistakes. Everyone makes mistakes. Nobody is right all the time. The key is to learn from your mistakes and not to repeat them again. Take the time to reflect on your missteps, identify what went wrong, and adjust your approach. Continuous improvement is really the name of the game here, and learning from your mistakes will give you the experience that you need and pave the way for more successful trading skills. Everyone is different and we handle our trades with a wide range of skills or knowledge, so your mistakes will show you what is most suitable for your trading style, will determine your trading style, learn what works for you, and you can apply it over and over again. This is the best way. So there you have it. These 10 mistakes are just the tip of the iceberg, my fellow traders. By steering clear of these pitfalls and embracing a disciplined approach to trading, you will significantly enhance your chances of success in these markets. So keep learning, keep growing, and keep chasing those profitable trades. If you like this type of content, let me know in the comments below. Also, hit that like button, help this video reach more people. Check out the links in the description below and my other golden nuggets that I shared with you in my previous episodes, and may the force be with you.